Hey guys, this is Gunjan Grover and today we will talk about actively managed versus passively managed funds. What is the difference between the two? Why are passively managed funds getting popular? How have they performed in the last 5 to 6 years? What are the latest trends in passive investing? We will discuss everything, but before that, don't forget to like this video and subscribe to Groww. So let's start with actively managed mutual funds. As the name suggests, in actively managed mutual funds, there is a dedicated fund manager who is very actively involved. He or she decides which stocks will go in and which ones will go out of an equity fund. How do they decide that? Well, there are lots of factors like the individual performance of the stocks, the performance of the larger markets and the economies, etc., etc. The fund manager also needs to decide if the existing stocks will remain in the same concentration or if the funds invested in the individual stocks need to be increased or decreased. In other words, a fund manager has a lot to do with an equity fund's performance. Here we took an example of an equity fund. It is the same case for all the other fund categories of the actively managed funds. Now let's talk about the passively managed mutual funds. In a passively managed fund, the fund is managed passively. Well, that means the manager buys and holds securities of a benchmark index. The fund manager follows the index and does not use their own discretion. The fund is essentially operated on autopilot. A passively managed fund is not necessarily an index fund, but it can be an index fund or an ETF. Let's take an example of an ETF that tracks the Sensex. It has all the stocks in the same proportion as the Sensex. What its fund manager will do is make minor changes in the fund so that the fund is in line with Sensex. Say if Sensex goes through any change of stock, that is, one existing stock could get removed from Sensex while another stock could get added to it. Then the fund manager will have to make the same adjustment in his or her fund. In passive portfolio management, the fund manager is expected to ape the benchmark's performance. Now, what are the benefits of passive investment? Number one, low fees. No one is selecting or picking stocks. Hence, the fee charged is low. Charges make a difference over the long term. Number two, diversified presence. When you invest in a passive fund that tracks a particular index, let's say Nifty 50, then you automatically invest in many stocks from different industries. Although this is not always true. Some funds track a particular sector like the pharma or the IT sector. In that case, an investor won't have any diversification benefits. Number three, simplicity. Investing in passive funds doesn't require you to take out time and research different stocks or mutual funds and deciding when to buy or sell. In the long run, if you believe that India as a country will grow, then Indian businesses are bound to grow. One can take advantage of that by simply investing in an index fund from time to time. Similarly, if you feel that a particular sector will do well, then you can invest in an index fund or ETF that tracks that particular sector. Number four, passive funds need to be seen more as an asset allocation tool. Passive investing may not be a substitute for equity investing, but some part of the equity allocation can definitely be in the passive assets like the index funds or ETFs. This will not only result in a more diversified portfolio, but will also make your portfolio less volatile. For example, stocks of one sector, say the IT sector, fall due to some bad news in the IT industry. Then all the other sectors will not fall immediately. The other stocks will prevent the portfolio from falling. The investors can choose to invest in different passive funds, which track different asset classes, different sectors, indices for different investment strategies, etc. The investors can now track major benchmark indices like the mid-cap indices, large-cap indices, value indices, etc. As such, the investors can structure their passive investment portfolio with a wide range of choices, making it easier for them to align such a portfolio with their risk appetite and financial goals. With the inflows and AUM, that is the assets under management data for passive schemes like the index funds, exchange traded funds, funds of funds, etc., it will not be wrong to conclude that while ETFs are currently capturing only 9% of the industry, their share is bound to grow further in the coming years, echoing the trend in developed countries like the United States. ETFs in these developed countries are very popular compared to countries like in India. Now let's look at the performance of the passive funds. According to a study conducted by ET, they looked at calendar year performance over the last 6 years. They compared the large cap category average with Nifty 100 TRI, that is the total return index, mid cap category with Nifty mid cap 150 TRI, and small cap category with Nifty small cap 100 TRI. They observed that the active large caps have underperformed 5 out of 6 years. Mid-cap has underperformed in 4 out of 6, but active small caps have outperformed the index in 5 out of 6 years. Hence, it might not be true that equity diversified funds have beaten passive index funds. In the past 6 calendar years, passive funds in the mid-cap and large-cap category have outperformed active funds. However, active funds in the small-cap category outperformed the index. In financial year 2021, most equity mutual fund schemes underperformed their benchmark indices despite the markets hitting new highs. For instance, 93% of the large-cap funds underperformed their benchmark index, while 82% of the small and the multi-cap funds performed below their benchmarks. Now, what have been the trends in passive investment? In the US, investors have moved their money to passive funds. Currently, passively managed funds in the US make up for more than 50% of the total mutual fund assets under management, that's AUM, compared to 20% of the total AUM in 2010. Currently, less than 10% of the mutual fund AUM is in passively managed funds. However, even in India, the AUM of passively managed funds is growing at a much higher rate than the actively managed funds. Passively managed funds, including index funds, gold exchange traded funds, other ETFs, and funds of funds investing overseas, registered a strong inflow of 68,678 crore rupees in the financial year ended March 2021, against an outflow of 21,000 crores logged by the actively managed equity funds. The AUM of the ETF increased 72% to 3.22 lakh crores in the last financial year. Index fund AUM was up 92% at 19,164 crore rupees. So more and more people seem to be interested in investing in passively managed funds. Hope you found all this information useful. If yes, then don't forget to like this video and subscribe to Groww. We don't recommend any particular fund or stock. All of this is just for educational purposes. On that note, here's me Gunjan signing off. Bye-bye. Take care. Keep calm and invest on.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.